Barrick Mining's net income surged by an astounding 142% year-over-year, yet its price-to-earnings ratio declined. Is the market missing a colossal opportunity, or is there a hidden reason astute investors need to uncover? The price-to-earnings ratio declined from 17.2 to 15.4. This isn't a blip, it's the market assigning a lower premium. The golden rule: don't just look at growth, understand how the market interprets it. A declining price-to-earnings ratio on soaring profits signals deeper questions for your investing strategy and fundamental analysis. This paradox leads to the real elephant in the room: intrinsic value discrepancy. Is Barrick Mining a hidden gem, a classic value investing opportunity? Barrick stock is currently $41.55. Most stop there. But deeper fundamental analysis reveals more. Intrinsic value is a company's true worth, regardless of market fluctuations. Benjamin Graham's formula calculates an intrinsic value of $114.76 per share. The discounted cash flow method, projecting future cash flows, estimates intrinsic value at $100.67 per share. Both suggest the stock is substantially undervalued by over 58%. This isn't just cheap. It's screaming mispricing. The market isn't always efficient. Master investors use intrinsic value to spot opportunities the crowd misses, a cornerstone of sound investing strategy and powerful value investing. To truly understand this value, we must dissect Barrick's profitability powerhouse. How is Barrick translating revenue into robust earnings? Revenue increased by 64.5% year over year to $5,997 million. Impressive. But EBITDA, operating profitability before non-cash expenses, rose by 91.5%, totaling $4,643 million. Crucially, net margin, revenue translating into net income, expanded significantly from 27.3% to 40.1%. This showcases Barrick's ability to efficiently convert sales into higher bottom-line profitability. Relying on just revenue growth is dangerous. True financial strength lies in efficiency. Net margin is your secret weapon. Grasp this, and you'll see financial reports in a new light. Beneath this gleaming surface, a subtle crack appears. Is the slight dip in operating margin a signal or a blip? The operating margin, profit on each dollar of sales after variable production costs, declined from 50.3% to 50.0%. Most ignore such small movements. But this decline is consistent with a long-term trend, signaling subtle pressures. This downward movement is an early indicator. Vigilant investors track trends, not just snapshots. Small changes can signal bigger shifts, especially with the price-to-earnings decline. This simple rule is powerful for your fundamental analysis. Yet Barrick's financial fortress seems impenetrable. How resilient is its financial health in volatile markets? Barrick boasts an exceptional Piotrowski F-score of 8 out of 9, assessing financial strength, and an Altman Z-score of 4.00, placing it firmly in the safe zone. The Z-score predicts bankruptcy risk. Here's the twist. Net operating cash flows, cash from operations, surged by 95.8%, reaching $2,630 million. Total cash and short-term investments climbed by 64.6%. These demonstrate exceptional liquidity and cash generation. They affirm impenetrable financial health, enabling Barrick to navigate market uncertainties and pursue strategic growth. Cash flow offers strategic optionality and resilience, strengthening your investing strategy. This financial strength offers freedom with debt management. Is Barrick's leverage a prudent tool? Despite increased total long-term debt, the long-term debt to EBITDA ratio, how easily a company can pay off its debt, declined from 157.9% to 109.1%, remaining safe. All key debt ratios like debt to assets and debt to equity remain low risk. This indicates improved debt servicing capacity. Debt isn't inherently bad, it's about the capacity to manage it. Ratios like long-term debt to EBITDA are more telling, showcasing disciplined capital structure. Assess this for yourself in your fundamental analysis. With this strong foundation, the question turns to unlocking asset potential. Is Barrick maximizing its asset base for optimal returns? The assets turnover ratio, how efficiently a company uses assets to generate revenue, increased from 0.30 to 0.33. Notice how it remains below 1.0. This suggests a substantial asset base relative to current revenue, implying underutilized resources. This isn't a weakness, it's a hidden opportunity for optimization, a growth lever yet to be pulled. For investors, look beyond current performance to identify where management can still create value. Underutilized assets can be future profit drivers, crucial for your investing strategy and value investing. Even a fortress like Barrick faces external headwinds. How do unpredictable market forces challenge its internal strength? Barrick is exposed to global commodity price fluctuations, especially gold and copper, directly influencing profitability. Despite robust internal financial management, external macroeconomic conditions like demand shifts or currency volatility, the US dollar index is at 99.8, trending down, pose persistent risks. Inflation, CPI at 2.4%, steady interest rates, Fed at 3.50% to 3.75%, and modest GDP growth, 1.4% for quarter four, are prevailing. This highlights the dynamic between Barrick's strong control and its volatile core markets. This is why your portfolio might feel stagnant. Understanding these headwinds enhances your stock market analysis. So what about that striking disconnect between Barrick's surging profits and its declining price-to-earnings ratio? Barrick is a financial powerhouse, revenue up 64.5% to $5,997 million, EBITDA up 91.5% to $4,643 million, net income soaring 141.6% to $2,406 million. It trades at a significant discount to its intrinsic value, boasts a fortress balance sheet, outstanding liquidity, free cash flow of $1,619 million, cash after expenses and capital expenditures, and disciplined debt management. The market's caution, reflected in its price-to-earnings ratio of 15.4, down from 17.2, appears to be a mispricing, not a fundamental flaw. This makes it a compelling target for value investing. I believe within 18 months, as stability improves, value investors will recognize Barrick's undeniable strength. This stock will see a significant re-rating, closing the gap to its true intrinsic value. This is why robust fundamental analysis is key to a successful investing strategy. But I want to hear your take. Do you think the market is underestimating Barrick Mining's intrinsic value, or are these external headwinds too significant to ignore? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.